This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on entering late in trends. A lot of institutional traders pay attention to line charts instead of candlestick charts or bar charts, and they're constructed from closes, and therefore the highest and lowest close of any swing becomes very important. Also, whenever the market's in a trend and then it does something to disappoint the trend traders, the market usually is soon going to transition into a trading range. You can see I have a grayed out candlestick chart in the background. This is a 5-minute chart of the euro versus the dollar. And superimposed on it, I have this dark green line, and that is a line chart. It's a line that simply connects the close of every bar. You can see the high of the day is actually above the high of the line chart, and the low of the day is below the low of the line chart. This is the low close of the day, and this is the high close of the day. The close of the day is always the most important price on any bar, and institutions that look at line charts only see closes. They do not see the actual high or the actual low. Again, the line chart simply shows one price every 5 minutes. It shows the final price of every 5 minutes. Whereas the candlestick chart shows all the trades that take place during the course of 5 minutes. This is a 5-minute chart, from the first trade to the highest trade to the final trade. Line chart simply connects the closes and ignores the actual highs and lows. This is the same chart, but now just a candlestick chart. And you can see the highest close. It looks like it was hit 2 or 3 times here. Certainly the 3 closes are very close to one another, and they're all below the actual high. A lot of bulls like to buy strong closes in bull trends, betting that the market will go higher. If you're a bull and you think the market's in a strong trend and you buy at the close of a bar, you want to make sure that the market continues higher, and you pay a lot of attention to the bar that follows the bar in which you bought that close. For example, here, you can see a bull who bought this close would be disappointed by this big bear bar, but look what happened when it got back to his close. Did he conclude that the trend had ended and that we were going to reverse down? No, the bulls did not sell. In fact, other bulls bought and the market went higher. However, look what took place here. If a bull bought this close, again, he's disappointed by this big reversal. What happened on the next bar? Did he buy again and did the market continue up? Or was it another weak bar indicating that a lot of the bulls who bought this close are now thinking the market might be transitioning into a trading range? So the bulls bought the close, they were disappointed by this reversal, and it looks like on this bar, the bulls stopped buying. In fact, they used this bar to get out break even. And other bulls who bought lower used this bar to take profits. And you can see what happened. Disappointed bulls selling to take profits or to get out break even. And bears see that as well. They see the lack of trend resumption up, and the bears start to sell as well, looking for a scalp down. Some bulls who did not get out here, after they saw this much selling, decided that maybe they should get out break even, and they placed a limit order to get out at their original close, and the market got close to it here and went slightly above the close right here, and that allowed them to get out break even at their original close. Bulls selling usually means you're going to get a leg down. A minor reversal, if it's big enough, can then lead to a major reversal on the next test of the high. This is a test of the highest close of the day. So some bulls bought that highest close, and the bulls needed this to go 1 pip above this high close to get out break even. And the market gave them a brief chance to do that. And the ones who did not take that opportunity to get out exited here. This is a give up bar. The bulls are giving up. And usually it results in at least a small second leg down, sometimes a bear trend. The bears know that the bulls have a problem. After this much of a reversal, the odds are the market is either going to be in a trading range and possibly a bear trend. They know that the bulls who bought here are hoping that after this sell-off, the market will get back to that price and they'll then be able to get out break even. The bears know the bulls are going to sell, and therefore the bears look to sell as well, hoping to catch either a scalp down in a trading range or a swing down in a bear trend. Whenever there's a trend, I always look at the first pullback or the first reversal down. And at that point, I can conclude that so far, at this point, this is the final bull trend bar. Trying to get a reversal up. At this point, if the market does continue up, this is the final bear trend bar. This is the final trend bar in the bear trend. At least at this point it is. Market reversing up. So this is the final trend bar in the bear trend, at least at this point. If the market gets lower, then it's not. Beginners are always afraid of reversals. However, whenever traders are afraid, it presents an opportunity to other traders who can trade objectively and not get involved with the emotions. After a bull trend reverses, it's easy to look back to find the final bull trend bar and the highest close of the bull trend. After a bear trend begins to reverse, it's easy to find the lowest close of the day and the final bear trend bar. The market often makes several attempts. For example, this might have been the start of a bear trend, and this was the lowest close of the bear trend, but we reversed up and then we got a lower low. Again, same here. This might be the low. This might be the low. This might be the low. This ended up being the low. Sometimes I'll hear traders talk about noise, that the market is making noise or this is noise. And it's not. Everything that happens is happening because computers have algorithms saying that placing trades is rational, it's logical, and it's profitable. The moves are often too small for you to trade, or you don't want to be trading on too small of a time frame, and you don't make decisions based upon that kind of price action. However, there's information there. So noise really cannot exist. I think it's a mistake to refer to things as noise. This is not noise. This is important information regarding the high close of the day. This is not noise. This is important information regarding the low close of the day. In a bear breakout, a lot of bears just sell closes, betting that the market is going lower. However, at some point, some bear is going to have sold the low close of the day, and he has to make decisions. Many of these bears will rely on a stop above the most recent major lower high right here, a lower high with a strong trend and a new low. That's major. It's a bear trend as long as it does not get above that high. And a lot of these bears will scale in higher, like on a reversal down from just below that high or below a bear bar, either here, or below this bear bar here as well. And then they have an average entry price. Let's say a bear sold here and then look to add on a reversal down here. He might wait for a second entry, 3 consecutive bull bars. He might not sell this, but he might sell the second entry. So his second entry is here, sells here, sells here. His average entry price is in between. Now, is the market going to let the bears out break even or with a profit? For example, if he sold here and here, will it come all the way back down below this low close and let him get out break even on this trade and then with a profit here? Or instead, will it come down somewhere in the middle and allow him to get out break even on his entire position with a loss on this entry and an equal profit on this entry? Look what took place. We have a double bottom here, but why? It's in part because a lot of the bears who sold this close were very disappointed by this, and they're placing limit orders to buy back their shorts at that low close. The market tried to get down there, but too many bulls buying and too many bears were so disappointed by this rally that instead of trying to get out break even, they were willing to take a small loss. They placed a limit order several pips above this close. The market tried to get down again and immediately reversed up again, and it did not even get below that low. Why is that? Because some of the bears who tried to get out with a couple pips loss, limit order slightly above this, and if they did not get filled here, they might raise their limit order a pip or two, and the bears are now willing to buy higher, willing to take a bigger loss. And that took place here. And the result is a bear trend, a bull breakout, and a double bottom, higher low, major trend reversal. The bears will buy back their shorts here. This is where the bears are giving up. And the bulls will buy as well, thinking that the bears had two opportunities to get out break even, and they could not get out. And the bears therefore are trapped and have to buy back their shorts higher. After this first test down, a lot of the bears said, well, it reversed up on this bull bar, and then it's reversing up again here. Rather than trying to get out break even on this short and with a profit on that short, I'm just going to get out at the midpoint between my two entries. And they place a limit order to get out break even here. Some who did not take that opportunity here, when the market started to sell off and then started to bounce, they quickly placed an order to get out break even here. So they lose some on this, they make some on this, and they get out break even. And the bears who did not take these opportunities to get out gave up and bought back here or even over here. Whenever the market's in a strong trend and then you're starting to get bad follow through, traders are disappointed, and the result usually is a trading range. I pay a lot of attention to what the market does after the market reverses. I want to see what it's doing around the low close. And the same is true here. In a bull trend, once it starts to reverse and gets back to that high close, what's the market going to do? Are traders selling or are they buying and the trend continues up? You can see up here, they're selling around that high close. And here, the market's reversing up. And look what happens when it gets near the low close. They're buying, they're buying. That increases the chances of either a trading range or a reversal. This tested the low close twice, and it only got within a couple pips. That tells you that the bears are buying back their shorts, and they are doubting that the bear trend will continue. And the bulls are buying as well. The bears are unwilling to sell down here. In fact, they're buying here. They only want to sell higher. That means the probability is the market's going to go up. And that's how a double bottom higher low is formed. You get sell the closed bears, sell the closed bears, sell the closed bears. And some bears sold this close, and they were disappointed by this follow through. They're hoping for one last test down where they could exit break even. Many of them, more experienced traders, will sell more higher, and that would give them the opportunity to get out break even on the trade and avoid a loss on this sell. or the possibility, if the sell-off down was strong enough, they could get out, break even on their first entry and with a profit on their second entry. When they see the sell-off looking weak like this, a lot of them are just going to try to get out break even instead of with a profit on their second entry and break even on their first entry. Remember, if you're trying to exit with a limit order at this low close, it has to fall one tick below that. Sometimes you're lucky and you get out without it falling below if it just touches, but 90% of the time it has to get below your limit order for you to get filled. And here, it only got to within a pip or two of your limit order, and therefore the bears trying to buy at this low close were not able. After one attempt, two attempts, three attempts, the bears buy back their shorts. And the bulls are buying as well. The bulls are buying here, knowing that the bears are desperate to get out break even. So the bulls are placing limit orders to buy just above that close. Usually if the market tries to do something 2 or 3 times and is unable to do it, it then tries to do the opposite. It went down, it went up, it went down, it went up, it went down, and it's going up again. Another bull bar closing on its high, a good buy signal bar. We're probably going higher for at least a couple legs. For the bulls, they're buying, betting that it's a double bottom, high or low, major trend reversal. It is, and it's a reasonable buy looking for a swing up or a reward that's at least twice as big as the risk, and that took place here. Here we have a sell-off and then a lower high. It looks like we're forming a bear channel. And after the market has been trading down for about 10 or 20 bars, what are the bears telling us? Are they acting as if the bulls are trapped and are desperate to get out? Do you get consecutive big bear bars with at least one of them closing on its low? If so, this usually represents the final bulls giving up, and you're probably going to get at least 2 legs down, maybe a measured move. It might be a measuring gap. When the bears see this breakout below this attempt at a wedge bottom, we have a spike, second push, third push. Instead of reversing up, we get a bear breakout. Bears start to sell closes, betting that the market's going lower. Instead, is a sell-off followed by an absence of consecutive big bear bars? Are we starting to get bull bars? Are we starting to get tails below the bars? If that's the case, then the bears are no longer confident. That was the case here and again here. This is not a strong sell-off. This looks more like a bear leg in a trading range and not a bear leg in a bear trend. This looks like a bear leg in a bear trend. You're probably going to get at least a second leg down, maybe more. If you start to get weaker bear bars, the absence of consecutive big bear bars, tails below the bars, and bull bars, that tells you that instead of the bears selling down here, the bears are scalping. They sold higher, and now they're switching to scalping. They're swing trading here, looking for at least a small second leg down. But when you start to see this kind of trading as the market's going down, it tells you that the bears are taking profits. They're switching from swing trading to scalping. And that usually means that the sell-off is probably a bear leg in a trading range. The same here, instead of a bear leg in a bear trend. And the bulls see this. They see the absence of strength on the part of the bears here, and they start to buy, especially below bars, betting on at least a scalp up. The bears have a strong breakout, probably will get at least a small second leg down, but they're disappointed by the big reversal here, a microdouble bottom, down and up on this bar, down and then up on this bar. And now we have another bar with a good sized body closing near its high. That is enough of a reversal to create a big down, big up environment and that usually leads to confusion. And when the market's confused, traders are less willing to hold on to trades. They tend to take quicker profits, and that includes the bears. They tend to buy back the shorts at prior lows instead of selling below prior lows, betting on a bear trend. The bears who are selling these closes, let's say this close, once he sees that, he starts to become concerned that he might have sold the lowest close of the bear trend, and the market might now be reversing either into a trading range or a bull trend. Once you start to see minor reversals that are fairly strong, the sell the close bears are disappointed, and now they think that a trading range or a pullback is much more likely than a continued bear trend. After this strong breakout, the odds are we're going to get one more leg down. The odds are this is a minor reversal, but it's a strong enough of a minor reversal so that when the market gets down near the old low, the bears will conclude that we're probably in a trading range, or maybe the bulls will get a major trend reversal on the test down, and the result is the bears will start to buy back their shorts at new lows or at that low close. And the bulls will buy at that level as well. The bears who sell these closes or sold for any reason, sold the market, selling for any reason, the stop is above the most recent major lower high, which is all the way up here, or they'll look at this breakout and say, okay, I'll sell closes, but I do not want it to get back above the high of the bear breakout. This is another reasonable place to place your stop. You're betting on two legs down. If instead it immediately goes up, then your premise of a second leg down is wrong, and you should get out. If you were a sell the close bear and you sold any of these closes and then you see this, what would you do? Would you continue to hold for a swing down, or would you think, this is a big enough reversal, we're probably going sideways, I think I'll start to scalp, so I'll look to get out around the bottom of the bear trend? And that's what took place here. Bears are buying back shorts, and bulls are starting to buy at the new low, betting that we're in a trading range instead of a bear trend. If the bear trend traders are giving up, then you might get a couple legs up, 10 bars, 2 legs up, and the bulls will start buying, betting that the bear trend is converting into a trading range. This is trading range type of price action. This is probably a bear leg and a trading range, and the same is true here. Sell the closed bear trend. Once you get a big tail or a bull bar, usually you're going to start to get an attempt at a trading range within the next 3 bars. Here we went down one more bar and then we went sideways. As a result, bears start to scalp more, but if you're scalping, you need more management. Most traders find it easier to swing trade, like selling a double top, lower high major trend reversal, buying a double bottom, higher low major trend reversal. But some traders will trade in here as well. If they do, it usually requires wide stops and scaling in and scalping. This would be an appropriate stop. No matter where you sold here, your stop is up here. If it goes above this, your premise of a bear trend is wrong and you need to get out. The close of a bull bar, some bears will sell more there, especially since it's a 50% pullback, and it's a breakout test. We have a wedge bottom, and this is testing that wedge bottom. We have an attempt at a double bottom, and this is a test of that bottom as well. Some bears who sold here are looking to scale in higher, and they might sell this bull close, especially if it's at least 10 pips above their first entry. If you're adding on in a bear trend, your minimum scalp size is 10 pips, always in the Forex markets. Therefore, you do not want to add on unless you're adding on at least 10 pips above your first entry. The odds are high that the first reversal up after a sell to close bear trend is minor, and that means the odds are high the market's going to go back down. If you sell more, at least the size of a scalp above your first entry, you know the market's probably going to get down there. Therefore, you can get out break even on your first entry when it gets back down here, and then with a scalp profit on your higher entry. You sell more and you place a limit order to get out break even at your original entry, and then with a 10 pip profit on your second entry. And you're selling more and you're trying to get out around this low close because you're disappointed by the size of this reversal up. It's a strong enough reversal up to make traders think that the market might be transitioning from a bear trend and into a trading range. I began by talking about the importance of the highest and lowest close, and that's because a lot of institutions do not use candle charts. They only use line charts, and line charts are based upon closes. So the highest point on a line chart is the highest close of the day, and traders will look for tests of that close. And the opposite is true at the bottom. If you get a reversal up from the bottom, the lowest close is therefore important support, and traders will look to see what happens if the market gets down near that support level. If the market's in a buy the close trend or a sell the close trend and does something to disappoint traders, traders are expecting a trading range and they're going to change how they trade. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on entering late in trends.